current state of the cannabis industry is a golden opportunity for investors, but we must be strategic and selective. Therefore, let's quickly analyse 3 of the best stocks in the industry. First up is Tilray Brands. After a merger with weed giant Aphria, Tilray is now the largest cannabis company in the world by both market cap and revenue, and if economies of scale are something to be considered, then Tilray's size could represent a huge advantage over the competition. Thanks to an early IPO back during the cannabis bubble, Tilray was able to raise a huge amount of investment. Granted, they wasted most of it on overpriced acquisitions, bloated headcount, and excessive expansion. However, they do still own some exciting acquisitions such as Manitoba Harvest, Sweetwater, and Breckenridge, which are all EBITDA profitable. Tilray expects their main business to become free cash flow positive for the first time in 2023. Although company revenue has grown over 350% in the past 3 years, which is the most on this list, the past 12 months were considerably slower, with sales increasing around 20%. That said, Tilray CEO Irwin Simon expects a huge re-acceleration in sales, claiming the business will reach $4 billion in revenue within the next few years. This sounds extreme, but with the recreational cannabis industry set to grow from $26 billion in 2022 to $198 billion in 2028, I guess anything's possible. However, right now, Tilray has a price to sales ratio of around 2.8, which is similar to the industry peers. Final note on Tilray, the stock is being held in 16 hedge funds, which is a lot more than the average cannabis stock. For example, only 9 hedge funds fancy their competitor Aurora Cannabis, and 13 hedge funds are invested in Canopy Growth. Canopy is the second name on my list and was formerly the largest cannabis company in the world. Thanks to a $4 billion investment from beverage giant Constellation Brands, Canopy Growth went and splashed the cash, acquiring several brands including Craft Grow, Tweed, Spectrum, and many, many more. Despite this investment, Canopy is not growing sales as fast as Tilray, with revenue rising 150% over the past 3 years and completely stalling in 2022. That said, Canopy's revenue should see a sharp increase when it closes pending acquisitions for US-based Acreage, Wana, and Jetty Extracts. These deals cannot complete until the US legalises cannabis at the federal level. After 4 years of unsuccessfully trying to turn a profit in the legalised Canadian market, Canopy is going all in the US, having recently rebranded as Canopy US. Legal sales of cannabis in the US have already surpassed $25 billion per annum, which is 10 times the market in Canada, and should also grow a lot quicker than the Canadian market if more states decide to legalise it. Therefore, Canopy's decision to focus on the US market seems sensible, and given their partnership with Constellation Brands, Canopy is in pole position if the US decides to completely legalise cannabis. Canopy will be hoping that this legalisation happens within the next 5 quarters, as that's roughly what the company has on hand given its current balance sheet and cash burn. Third on this list, and perhaps a less risky investment, is global biopharma business Jazz Pharma. Owned by 43 hedge funds, this fast-growing and profitable business is a slightly different and more diversified way to invest in the cannabis industry. Better known for its specialised treatments for sleeping disorders and cancer, the company's recent $7 billion acquisition of GW Pharmaceuticals gives it a huge footprint in the medicinal cannabis industry, which is set to grow from $8 billion in 2022 to $54 billion in sales by 2030. Thanks to its merger with GW, the company now owns the only FDA-approved cannabinoid on the market, and after recently gaining approval in Europe, analysts predict that Epidiolex could reach $1.4 billion in annual sales by 2025. The drug is also undergoing trials for the treatment of autism, PTSD, schizophrenia, and other neurological disorders. Jazz is trading at a similar price to sales ratio as Tilray and Canopy, and although 3-year sales growth of 50% is slower than the others, Jazz is already profitable and growing its earnings at a steady rate of 20 to 30% per annum. Last on this list is a bit of a risky one, and that's WM Technology. Again, a rather unconventional play on the cannabis industry. WM operates the leading online cannabis marketplace and provides e-commerce and software solutions to the cannabis industry. Once valued at 30 times sales during the tech-backed cannabis bubble, shares of WM Technology are down 96% and trade at around 1 times price to sales. sales. That makes the company a lot more investable, especially considering the business is profitable with healthy profit margins in the region of 25 to 30%. That said, there's a large red flag to consider. It's likely that WM's lack of compliance is allowing a number of unlicensed cannabis sellers onto their platform. In fact, they now have more California-based vendors on their e-commerce platform than there are licensed vendors in the States. Therefore, any regulatory crackdown could not only limit WM's future growth potential, but perhaps even reduce their existing customer base. Plus, consider any fines and bad press that would likely come their way. Remember, high-growth industries will always carry more risk and more volatility. However, after a year of tumbling valuations in all growth stocks, the potential for huge profits, especially within the cannabis space, are definitely back. Please note, I'm not a financial advisor. This is not financial advice. And remember, your money should be working for you and not the other way around.